right, let's talk about a stock that's in an absolute free fall. A company that is burning through cash at an alarming rate, but at the same time is pitching this incredible story of a glorious rebirth. Today, we're putting Gemini on the anvil, and we're going to stress test it. Welcome to Iron Financial, the place where we help you forge a stronger portfolio by cutting through the market noise and hammering away at the fundamentals. Our mission today is simple. We're going to find out if GMI is truly building a new foundation for growth, or if the entire structure is about to collapse under its own weight. Let's get to work. Just look at this chart. It is absolutely brutal. I mean, from its high just a few months ago, back in January, GME has been completely and utterly decimated. We're talking about a nearly 50% haircut. Now, this isn't just some healthy pullback. This is a cliff dive. And this kind of violent price action, it forces you to ask a really critical question. Is there any structural integrity left here at all? Are we looking at a once-in-a-lifetime deep value opportunity, or is the market doing its job and correctly pricing in a future of total failure? The price on your screen, it tells a story of pure panic, but we need to dig in and find out if that panic is actually justified. And right when you thought it couldn't possibly get any worse, Wall Street decides to throw a tanker of gasoline on the fire. Citi comes out swinging with a hard sell rating, and they don't just trim their price target, they slash it down to $5.50. Think about that. That target implies there's even more pain to come from where we are today. So is this it? Is this the final nail in the coffin? Is this a major institution seeing fatal cracks in the foundation that the rest of us are missing? Or is this just the kind of Wall Street noise we're supposed to tune out? That is the core conflict we are breaking down right now. Okay, but every story, especially in the markets, has two sides. Despite that ugly stock chart, despite the Citi downgrade, management is out there painting a very, very different picture. They're not talking about just surviving, no, they're talking about a renaissance, and they've branded it Gemini 2.0. Listen, this isn't some minor course correction they're proposing. This is a full-blown attempt to completely reforge the company's foundation from the ground up, with a brand new blueprint for the future. So let's do our job. Let's suspend our disbelief for a moment and really build out the bull case. Let's see what they're selling. So the way they're justifying these massive sweeping layoffs, well, that's the first pillar of their turnaround story. Radical efficiency, all powered by AI. The founders are out there arguing that AI has created this massive paradigm shift. It's turning their best engineers into, and I'm quoting here, 100Xers. The idea is that they can do way more with way less. This is how they justify cutting their workforce by another 25%, and remember, that's after they already cut it in half since 2022. The bull case here is that this is not a sign of weakness. It's a calculated strategic move to forge a leaner, faster, more potent organization that's built for the modern era. They're trying to build a smaller but much stronger core. The second pillar of this bull case is even more ambitious. Honestly, this is a massive bet the farm kind of strategic pivot. They are going all in on prediction markets. And their thesis is incredibly bold. They're claiming that this new frontier could one day be larger than all of today's capital markets combined. I mean, that is a monumental claim. By going out and securing a license and launching their platform, they're positioning themselves as a first mover in what could eventually be a multi-trillion-dollar industry. The bull argument is that the old crypto exchange business, well, that's just legacy now. The real growth engine, the entire future of the company, is in becoming the world's de facto truth machine. And the third pillar of their turnaround plan is simple: focus. The founders have openly admitted they got stretched way too thin. They were operating in over 60 countries where they just couldn't win. So their new blueprint is to retreat and refocus. They're pulling out of the UK, the EU, and Australia so they can double down on their home turf, America. The plan is dead simple. Simplify by cutting the complexity that was driving up their costs, consolidate their strength in their most promising markets, and then, and only then, hit the accelerator. For the bulls, this is a clear sign of mature leadership. It's about recognizing your mistakes and making the hard, painful choices needed to build a truly profitable enterprise. So you have to ask yourself, is this all just a story? Is it just some grand narrative designed to distract everyone from the collapsing stock price? Well, the bulls will point you directly to this number. In the fourth quarter, Gemini reported revenue of $60.3 million. Now, why does that matter so much? Because the Wall Street consensus, the smart money, they were only expecting $51.7 million. That's not just a beat. That is a significant, substantial beat. It's a hard piece of data that suggests maybe, just maybe, something in their new strategy is actually starting to work. It's the first real, tangible piece of evidence that this turnaround story might actually have some steel in it. Now hold on, a single revenue beat does not make a turnaround. So we have to ask the hard question, is this just a dead cat bounce, or is it the beginning of a real, sustainable trend? As analysts, we have to look under the hood. And when we break down that $60.3 million number, we see it's probably not just a fluke. They're showing real strength in their credit card business, which is great because it diversifies them away from that pure crypto volatility. They've also revised their fee structure, and critically, their user base is growing. They reported 606,000 monthly transacting users, so the bull argument gets stronger. This isn't just a one-off number, it's a sign of positive momentum across multiple strengthening business lines. Now, let's shift over to the 8K filing, the legal document, and see how this all builds into a formal plan. This isn't just some rah-rah blog post. This is a documented corporate strategy filed with the SEC. Step 1. Simplify. Get out of those difficult, low-return foreign markets. Step 2. Consolidate. Funnel all those resources into the US and Singapore, their core strongholds where they can win. And step 3. Accelerate. This whole painful process is designed for one thing: to support their path to profitability. And of course, it comes with a cost. They expect to take a hit of about $11 million in pre-tax restructuring charges. This isn't a panicked reaction. It's a deliberate, calculated, and costly strategy to reforge the company into something that can actually be profitable. And finally, the bulls will point to this right here, that massive company-altering pivot into prediction markets. It's not just some theoretical idea on a whiteboard anymore. It is happening. It's live. And it's showing early signs of life. Since they launched in mid-December, they've already seen over $24 million traded on the platform. And that's by more than 10,000 users. Now, let's be real. In the grand scheme of the financial world, these are pretty small numbers. But as a proof of concept, it's incredibly powerful. It shows there's real demand. It suggests that the new foundation they're trying to build is actually being laid, and people are starting to show up with their money. All right, so that's the story. A powerful, compelling narrative of transformation, of AI, of new frontiers. It's the kind of story that gets investors excited. But a story doesn't pay the bills. A story doesn't service debt. Now it's time to put on the hard hat and stress test this entire structure. We need to look right past the narrative and start examining the financial bedrock that it's supposedly built on. Because the bear case argues that Gemini isn't forging a new foundation, it's building a skyscraper on a pile of sand. Let's see if this company can actually bear any weight at all. And here is the first swing of the hammer against that bull case. Yes, they beat on revenue. We saw that. It was impressive. But where did all that revenue go? Because the company reported a GAAP loss of $1.22 per share. The market, Wall Street, was only bracing for a loss of $1.13. So for every single bit of good news you got on the top line, there was even worse news waiting for you on the bottom line. This company is growing its revenue, but it is bleeding cash even faster. A bear would argue, quite correctly, that this is the textbook definition of unsustainable growth. What good is more revenue if your losses are accelerating out of control? Okay, now let's drill down into the guts of the operation. This number you're looking at is the operating margin, and it is absolutely, positively abysmal, a negative 159%. Let me put that in very simple terms for you. For every single dollar in revenue that Gemini brings in from its core business, from trading fees, from card fees, from all of it, it is spending roughly $2.60 just to generate that $1. This isn't a company that's just struggling with profitability. This is a company whose core business model is fundamentally, structurally broken. It's like a machine that burns more fuel than it produces. It just makes no sense. And if you thought that was bad, just take a look at the net margin. After you account for everything, all expenses, interest on their debt, taxes, the whole picture, it gets even worse, negative 198%. This means after everything is said and done, the company is losing nearly $2 for every single $1 of revenue it makes. How can you possibly talk about a path to profitability with a straight face when your financials look like this? The bear case is brutally simple. The hole is getting deeper, and the company is just shoveling faster. This isn't a small crack in the armor. The armor itself is disintegrating before our eyes. So this brings us to the most crucial point, this stark, unavoidable contradiction. On one hand, you have management's promise, and this is taken directly from their SEC filing, to support the company's path to profitability. That's the story. On the other hand, you have the cold, hard reality, a quantitative measure of bankruptcy risk called the Altman Z-score. Gemini's Z-score is 0. A score below 1.8 indicates a company is in financial distress and has a high probability of going bankrupt. A score of 0 is a screaming 5-alarm fire red alert. The narrative from management and the numbers from the financial statements are telling two completely different, mutually exclusive stories. And in our experience, the numbers, they don't lie. And it doesn't stop there. Let's just tick through the other warning signs from the Guru Focus report, shall we? First, insiders, the people who know the company better than anyone else. In just the last 3 months, they've sold nearly 40,000 shares. You have to ask yourself, why should you be buying when they are selling? Second, revenue. For all the talk of growth, their trailing 12-month revenue has been basically stagnant for 3 years. There is no long-term growth trend here. And third, the balance sheet itself is weak. A debt-to-equity ratio of 1.6 means the company is heavily reliant on debt financing. A heavy debt load on a company that isn't profitable and isn't growing, well, that's a recipe for disaster. Okay, so we have two diametrically opposed theses in front of us. On one side, the bull case, a visionary company reforging itself with AI and a bold pivot into a massive new market, and it has some early signs of validation. On the other side, the bear case, a company in deep financial distress with horrific margins, a broken business model, and a balance sheet that is leveraged to the hilt. So where do we land? Is this solid metal ready to be forged into something great? Or is it a brittle, cheap alloy that's about to shatter into a million pieces? It's time to weigh the evidence. This table really lays it all out, side by side. The bull case rests entirely on the forward-looking story. You're betting on that strong Q4 revenue beat, that powerful pivot into a huge new market, the growing user numbers, and valuation metrics like price to sales that are near one-year lows. But the bear case is rooted in the brutal present-day reality, the EPS miss that completely wiped out the revenue beat, those catastrophic margins, the high debt, that financial distress Z-score, and the fact that insiders are heading for the exits. The bull argument is that the story is so powerful it will eventually fix the financials. The bear argument is that the financials are so weak they will inevitably crush the story. And this right here is exactly why Wall Street is so conflicted. It is a classic battle of narratives. The bulls, they look at that mean analyst target of over $13 and they see a clear path to doubling their money. They're betting that this turnaround will take hold. But the skeptics, and this is the argument from Citi, they say you have to weigh a fresh, specific downgrade much more heavily than some stale average of older, rosier predictions. They're arguing that the newest data points to severe structural risk that isn't fully priced into the stock, even after a 50% drop. You know, this really all boils down to one fundamental question for any investor looking at this stock. What do you weigh more heavily? For these disruptive tech companies, the argument is often that you have to invest in the narrative first. You bet on the vision, you bet on the total addressable market, you bet on the management team, and you just have to trust that the financials will eventually follow. But the counter-argument, the old-school fundamental approach, is that financials are like gravity. A great story doesn't pay the interest on your debt. A great story doesn't fix a negative 198% net margin. Eventually, reality always catches up. So our verdict here is this. Investing in GEMI today is not a bet on its current business. It is a pure, unadulterated, high-risk, high-reward bet on management's ability to execute a flawless turnaround. The Gemini 2.0 narrative is strong, it's clear, and it's certainly ambitious. But the financial turnaround, that is the real heavy lifting. They have to simultaneously launch a brand new, unproven business and prediction markets while fundamentally restructuring and fixing their hemorrhaging core operations. It's an incredibly difficult task, a real tightrope walk, and there is almost zero room for error. And that leaves us with the final question, and this one is for you. Management is telling you that they can build a fortress on what appears to be a deeply, fundamentally cracked foundation. They believe that the new materials they're using, AI and prediction markets, are strong enough to overcome all of the existing weaknesses. And look, the potential reward is immense if they somehow pull this off, but the risk of a total collapse, given the data we've just walked through, is just as real. So you have to ask yourself, is that a risk your portfolio is forged to withstand? That's your decision to make. This is Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.